the Emerging Markets Equities podcast by Aberdeen.
Hello, this is Nick Robinson from Aberdeen, and you're listening to the Emerging Market Equity Podcast. Together with our expert guests, we'll dive into the driving forces behind emerging markets and uncover the opportunities that are shaping the future of this exciting region. So the last 20 years has seen huge changes in emerging markets. Some countries, particularly those in Asia, have made huge strides forward in terms of economic development, while some others still lurch from crisis to crisis. We've seen a huge broadening out of company choice as markets become less dominated by those kind of historic state-controlled companies, and that's being driven by real entrepreneurs that are building and listing businesses locally. Whilst this process has been ongoing, huge amounts of wealth has been created, and this wealth creation has also led to another key shift in emerging markets, and that's shifting capital flows and the rise of the domestic emerging market investor, be they governments, companies, or individuals. So today I wanted to shift the conversation a bit and think about trends related to the changing investors in emerging markets, how capital flows are shifting, and the impact this is having on emerging markets. So I'm delighted to be joined by two colleagues who are extremely well placed to comment on these trends. Firstly, Peter Dunbar, who heads up our business in the UAE, so he's very close to all that Middle Eastern capital. Welcome, Peter.
Nick, thank you very much, and pleasure to be here. Much appreciate you giving me the opportunity to join.
Great, and then also we have Alex Smith as well, who's an equity investment specialist based out of Singapore, so very well versed in all the changes occurring to Asian capital flows. Welcome to you too, Alex.
Hi, Nick. Thank you very much for having me on today.
Well, it's a pleasure to have you both on. Perhaps to kick off, you could give us a bit of colour on your experience, both of you as expats. Firstly, in the UAE, Peter.
Thank you, Nick. So you mentioned a lot of change in emerging markets over the last 20 years. And I think I would argue that probably the Middle East has seen more change than anywhere else. As we look back, we had oil price peaking at 140 back in July 2008. This was a time of kind of huge growth in the region, and then the financial crisis came along, and things changed very quickly. The Dubai stock market was down around 72% in 2008, and it entered into a very challenging period for the region. I myself first moved to the Middle East in 2010. And my recollection of arriving was seeing shells of buildings and apartments everywhere, just abandoned projects, and reports of cars in the thousands being abandoned at Dubai airport as expats left. At the time, many people, many commentators would laugh at people. They'd laugh and say, look at these buildings. Why did people build these in the desert? And this is thinking of it as a failed project. And when we look 15 years on, how much things have changed, because these same shells of buildings are now luxury villas, which are going for millions of dollars. And, I've been fortunate enough to be in the region and witness such a huge change. And the growth has really been quite incredible. During my time at Aberdeen, we were actually the first asset manager to set up in the ADGM. This was the free zone in Abu Dhabi. When I first moved there, there were many free offices and it really felt very quiet. But over time, what's happened is it's just become more and more busy. And last year, the free zone expanded to take on another island in Abu Dhabi. And so, my experience has been one of huge growth and huge opportunity, which I've been fortunate to be part of.
Yeah, no, and that's really interesting. I remember the financial crisis hit the region so hard, and it took years for investors to get comfortable again with the region after that, given how impactful it was. But certainly that's now happening from an emerging market perspective. What about you, Alex? How's your experience in Singapore been so far?
Yeah, thanks. Well, I'm not such a sort of storied expat as Peter, so I've been out here for 3 years. I moved from London in 2022, just after they'd sort of got rid of all the kind of COVID restrictions, which had been here for a long time. I mean, coming here, I have to say, is pretty seamless, right? It's such an efficient place. English is the first language, and there's a real established community of Brits here. So, you can get your things like all the kind of comforts of home, like brown sauce and tea, etc. So, it has been a very, very easy place to live. I think, one change, if you think about an important moment for Singapore and Hong Kong as well, was COVID. So a lot of people and expats actually left after COVID. People just became uncomfortable with the level of restrictions, I think. That they're slowly starting to come back. And there's still a very vibrant expat scene, but there's definitely been a marked change in things that people talk about before COVID to now, which I think is quite interesting. But I have to say, it's been a very positive experience and really quite a smooth one overall.
That is great. I'm very relieved that you could still get your brown sauce and tea. That was something we were very worried about when you moved over. So thank goodness for that. Perhaps if we kick off, thinking about global capital flows, both Asia and the Middle East have been seen historically as sources of capital into the US, but we're seeing some signs that that's beginning to change. Perhaps you could talk us through that, kicking off with Alex.
I think this is really interesting, as you say, because traditionally what's gone on for the last sort of 10 odd years at least has been, exporters in Asia have built up surpluses, and largely that's been invested into US assets. And that is across pension funds, governments, retail investors. So it's a very broad based kind of pattern of behavior. So there's different drivers. But, we've seen this year, it's shown up in the currency markets. The Taiwan dollar's up 8% versus the US dollar this year. And Taiwan is a mercantilist economy, so they weaken their currency to make their exports more competitive. Been incredibly successful at this. Um, but why is this changing? Well, we've seen, in the US, this policy of deliberately focusing more on real assets. So trying to make, basically making stuff a bigger portion of the economy than the capital markets, and also encouraging countries to do things like spending on defense. It's true in Europe, it's also true in Asia. And so what does that mean? Well, it means this flow of capital is going to change, right? So some of that money that's been invested into the US will come back domestically to improve the defense industry, or some of it will go into the US economy to build factories. I mean, TSMC, it's a good example of this. They're spending capex in the US. And to do that, you probably want the dollar weaker as well. That's not an explicit policy, but I think it's pretty heavily implied from what they're doing. And I just want to quote Scott Bessent, who gives the clearance to the US Treasury Secretary, who kind of puts this idea most neatly. This was him in April 2025 this year. It's Main Street's turn to hire workers. It's Main Street's turn to drive investments. And it's Main Street's turn to revive the American dream. Now, yeah, what are you saying there? You want to shrink the size of the capital markets as a portion of the US economy and build up real assets. And this foreign liquidity dynamic is a crucial part of that.
Right, and the when we kind of look at the Middle East, I suppose it's slightly different there in that we've got pegged currency, so haven't really benefited from those fluctuations in currencies. Peter, what's your perspective on this?
Yeah, well, look, I think historically the Middle East was always seen as a source of capital. And when asset managers interacted with the region, it was very much historically that was the nature of the relationship. But I think what's really changed in recent years is that asset managers such as Aberdeen are seeing significantly more opportunity in the region than they ever did before. We actually did a review of our equity holdings in the Middle East versus where they were 5 years ago, and we're investing 15 times as much equity capital into the region. We've also launched GCC Infrastructure JV, which is deploying sizably into the region as well, and also on the fixed income side. So I've seen, a complete change where the region is being viewed as an area of opportunity. There have also been important changes and reforms which have helped develop this. And in 2019, when the Saudi Tadawul entered into the MSCI emerging markets, this triggered a significant inflow of money, both passive and also active, as that market became more available for investment.
Yeah, no, you're right to highlight the investability of the Middle East at the moment. I feel like every week I'm pointing out to clients now that the Middle East, in terms of opportunity size, as represented by the emerging market benchmark, it's actually pretty similar to LATAM these days, which I don't think most people who aren't in emerging markets every day is something that they realise. Both of you have pretty good visibility into what clients are doing at the moment. What's your perspective on clients and their allocations, particularly regarding allocations towards emerging markets? Because one theme that's been dominant recently has just been the kind of under allocation towards emerging markets and the potential for more client allocations, particularly as the US is a bit wobbly at the moment.
Yeah, perhaps I'll start with that one, Nick. I mean, I think it's fair to say like there's been a warming up to changing allocations in emerging markets. So I can certainly sense client interest rising. And look, we're one of the biggest investors in Asia and EM, so we have a global business. So you do get a good sense of what allocators are thinking about across the world. And I think there's more conversations happening, there's more interest, but flows have not really picked up. EM has been attracting as an allocation, it has attracted positive flows. It's the only asset class to do that since 2012. Positive flows alongside developed markets, global allocations in the US. But as a portion of assets, it's really shrunk. So, incrementally more money's gone to the US, more money's gone to developed markets. EM is about, if you look at EPRF data, it's about 5 to 6% of client portfolios. It's around 12% of the ACWI, but the US is 65% of the ACWI, MSCI ACWI benchmark, 72% of the MSCI world benchmark. So the US is still very, very dominant. And I think that when I was talking earlier about this flow of liquidity into the US being, some government assets, pension funds and retail assets, or kind of asset allocators, we call them, asset allocations don't necessarily move that quickly. So I wouldn't say that we've yet seen clients start to wholesale shift. But if they do shift, and I think this is worth mentioning because you touched on the size of the market cap of MSCI EM is 7 times larger than it was in 2008. And that's because been helped by domestic investors and market openings in China and the Middle East as well. Small caps, similarly, market cap is 7 times larger than it was in 2008. So the potential to absorb assets is actually a lot higher when asset allocators do start to come back, perhaps go overweight. And even those numbers kind of underestimate, you've got India 7 trillion market cap market and China sort of 12 trillion. They're both underrepresented in MSCI EM. So it's just this vast kind of iceberg underneath global markets.
Yeah, and Peter, are you seeing any shifts in terms of where your clients are thinking about investing?
I think, Nick, probably my observations are quite similar to Alex's. So, Middle Eastern investors have been allocated to emerging markets significantly for a number of years. I'd say that there's increased dialogue and increased interest as we're seeing the relative performance versus DM pick up. And I think there is an acknowledgement amongst investors that there are some pretty serious challenges facing the developed market countries, both in terms of budget positions and political uncertainty. And actually, in many cases, emerging markets are very well placed. And so, although I haven't seen significant moves into emerging markets, I think we're not too far away from seeing that from Middle Eastern investors.
Yeah, I suppose one thing that's been quite interesting is if you think about the changing kind of flows and investment base in emerging markets. Much has been made of the rise of domestic investors, and particularly things like the domestic pension fund industry. That generally being seen as quite a good thing for local markets, in that markets become less dominated by kind of so-called foreign hot money that kind of comes and goes, and actually there's a more permanent capital base that's investing in markets locally. When you look at your respective markets, and perhaps we'll touch on the Asian ones first. Are they fairly homogenous in terms of the amount of domestic investment into their markets that we're seeing, or is there quite a big difference in terms of which countries tend to be larger domestic investors versus others?
Yeah, there are. It's a good question. There are significant differences across the region, and I think it's definitely true that the capital base has been building up in these countries as they get wealthier. It sort of happens naturally alongside GDP. There's some areas where retail investors are very dominant. So China is, I think a huge portion of the market there is owned by retail investors. Foreign ownership is a small sub 10% portion of overall Chinese ownership, and that's because it's partly because it's very difficult to access the market. And we're seeing the rise of the retail investor in other places. So India is clearly the most interesting in this department. I mean, they've brought through some of the reforms they've brought through was making it easier to invest in your pension in these systematic investment plans, SIPs, they're called in India. And that is just literally, millions upon millions of Indians adding 10% or so of their salary every month and investing it in the market. They're adding 3 billion US a month to the market. This has just grown month on month. So, it's true that the capital bases are changing. Like in developed markets, retail is playing a bigger role in various ways. So yeah, it's something to watch, and it is very, very interesting. Just on the domestic pension industries and that sort of thing. I think, my experience, we are a global asset manager, so we would be dealing with non-domestic allocations typically, and they do tend to still be very biased towards the US and developed markets, right? In terms of what we see. So I think that's the institutional investments is dealt domestic investments dealt with slightly differently to what we see.
Yeah, and Peter, I suppose in the Middle East, you've got all these very well capitalized sovereign wealth funds. Have you seen much shift in terms of how they're investing?
I haven't seen any immediate shift in terms of their international exposures, but I think what's been clear is that the overall strategic direction has changed, and there's been even more emphasis placed on what's happening at home. So it doesn't matter whether you're talking about UAE, Kuwait, Saudi, Qatar, they're all looking to diversify away from oil, build out their local economies. And this is something which they're being very, very successful with. And I think infrastructure is one of the key enablers for everything that they're trying to do. I would say there are some distinctions between the countries, and a lot of this comes down to the level of natural resources that each of the different GCC countries have, but then also in terms of the population.
And the retail investors in the Middle East, do they have much of an impact on markets?
I think relative to Asia, Nick, it would be significantly less. It's still very much an institutional and government-led, initiatives. But the Saudis are the most urgent in terms of their need for diversification because the population of local Saudis is over 20 million. And you can compare that to UAE with 1 million and Qatar with under 500,000. So there's definitely some differences in terms of the urgency, but the direction is consistent across the board.
Great. And Peter, I wanted to actually pick up on an issue that you raised a minute ago, just on capital market reforms. And see, things have been changing in Saudi quite a bit lately. And I think even in the last few days, there's been some news about potentially relaxing foreign ownership limits on Saudi companies. How important are those kind of things to local capital markets?
Nick, I think has transformed it. So I think historically GCC markets were seen as being, opaque. The regulation wasn't seen as being market leading. And these changes have meant that the capital markets are much more accessible for international investors, which has been huge. And these reforms have included things like market settlement, lifting of short selling restrictions, introduction of the derivatives market. So these are all kind of key reforms that have taken place and have led to the growth. And it feels like it's unlocked billions of capitals, but I feel there's still further that this can go.
Yeah, no, I mean, I remember years ago we ran a fund that could invest in Saudi back in the day when it was quite challenging to invest in Saudi from a regulatory perspective. Yeah, we struggled for years to actually get the local Saudi market open in terms of getting the paperwork done and getting compliance comfortable with some of the settlement issues in the market. So that really contrasts with today, where it's relatively straightforward now opening Saudi or indeed any of the Middle East markets.
Indeed, and I think, sorry, just Nick, just to jump in as one final point on this is that in addition to the kind of stock markets, I think what you've seen is there are some free zones and financial hubs that are beginning to really develop. So both the ADGM, which is where we're based, and then the DIFC in Dubai, and then clearly the CMA in Saudi. These regulators are becoming more and more highly sought after, and this is becoming a place where people feel that they can actually set up their businesses and invest from. And certainly in Abu Dhabi, we've seen a number of hedge funds decide to move significant presence, not just from a distribution or operational perspective, but actually the key investment decision makers being based in the region, which again is a big support for the local markets.
Yeah, no, absolutely. And yeah, that's one of our principles behind having quite a large position in the UAE in our emerging market funds is just this business formation that we're seeing, and that just driving all other parts of the economy, including the banking sector and the property sector and the like. And yeah, it's a very exciting region from an EM perspective today. Thinking about Asia, Alex, obviously huge reforms have been going on in places like Korea and China. I feel like Asia is a bit more developed in some of these reforms, perhaps relative to the Middle East.
Yeah, I think so. And yeah, so you're not looking at reforms that are kind of as transformational, but you're coming from a much better starting point. But I think it would be stupid to overlook how important some of the reforms are in Asia. Yeah, and it's not actually an EM, but I think Japan has played quite an important role in this. Very typical North Asian country, so it's got a lot in common with Taiwan and China. Big reserves, not a fantastic capital market relative to its development. And the TSE has gone through this program, delisting, breaking up these conglomerates. And I think that that's inspired change. And certainly other countries and other policymakers are trying to replicate the success that Japan has started to have in transforming its capital markets. So you've got, in China, you've got this SOE reform program. You've also got opening up of new exchanges to get money to innovation. I mean, clearly that must have been pretty helpful because innovation's ripping in China at the moment. In Korea, you've got value up. I mean, that's a lot about better conditions for dividends, encouraging share buybacks, more transparency, so breaking up these chaebol networks that dominate the listed markets. So yeah, so those North Asia's reforming, trying to open up more areas to invest in, and I think that will help. It can also help with wealth inequality because the property market, where a lot of assets are, is quite tricky for a lot of Koreans to get into. In South Asia, actually, it's different. I would say challenge is liquidity, pretty consistently, actually. So governments are trying to inject liquidity in various different ways. Most of the Southeast Asian markets struggle with this. Recently, MAS, which is the Monetary Authority of Singapore, has come out with a mandate. They're going to invest 5 billion Sing into small and mid cap stocks in Singapore. I mean, these names are so illiquid at the moment. Singapore sort of concentrated in a few banking stocks, and that's pulled liquidity out of the bottom end of the market. So they're trying to tackle this, and then they've been giving mandates to managers to invest in small caps and to trade more frequently. Philippines overhauling tax and various other things. India similarly is taking measures to reduce the administrative burden of investing in India for foreigners.
No, that's interesting what you mentioned about Singapore and the so-called national team buying. We've seen plenty of that out of China, certainly in the last couple of years. I mean, I suppose, thinking about reforms and, particularly in China, the idea that property shouldn't be used as an investment asset. Are we seeing, generally retail investors shift away from property as their largest asset within the household? And are we seeing governments, more successful in promoting equity investment in the various regions?
I think this is very, very ingrained in the mindset here in terms of how people think about investing and what assets should do. So I don't think that has substantially changed, but definitely in Singapore there is efforts to try and change this. So that what you will find is when investors invest in equity markets or bond markets, they treat it as if they're investing in a property. That's how they view it. So that means they focus on yield at the expense of capital returns, and they might well use a lot of leverage to do it. And that's how they think. Well, how much do I get paid by this investment? And I want that payment monthly. And if you can get a product that yields 10% and pays monthly, you're going to sell a lot of that product in the wholesale market out here. Okay. Of course, that erodes your capital. So the Singaporean government certainly, and some of our clients in Singapore, particularly the global banks, have really pushed an education program. They really push this focus on total returns. But I would say this behavior and mindset is very ingrained. And part of it, as you suggest, Nick, is that if you view property as an investment, and as a Singaporean, most of your money's in your properties, you're less bothered by the capital returns on your investment portfolio, right? But if you're a Western investor and you've got your pension, you're depending on it, you really need to maximize the total returns from it. So I would say that still persists. It's something that they're trying to change.
Yeah, and I guess Peter, in your region and the UAE, I would imagine property is still the key asset within households, given how equity markets are still relatively undeveloped.
I think that's fair, Nick. Real estate is a big part of the economy as a percentage. And historically, this is what people have chosen to invest in. And I haven't seen any major change to that. It is almost the default that people do with their savings is buy property. Um, Mutual funds, there is increasing interest, but I think that people still value being able to kind of touch and feel property in a way that they can't quite do the same in terms of a mutual fund. And I think similarly to Asia, there is a real focus on yield when they do. Maybe with time we'll see things change, and there's a number of pension schemes which are beginning to develop here in the region, which are giving people more option to invest in mutual funds. But still, at the moment, it's very property focused.
Well, guys, I think that's probably a pretty good place to wrap things up. So, yeah, thanks very much to both Peter and Alex for joining the podcast.
Thanks, Nick. It was a real pleasure joining you.
Yeah, thank you, Nick. Thank you, Alex.
Great, and thanks to everyone who took the time today to listen in. If you enjoyed it, then please download our other podcasts from our website or wherever you normally get your podcasts. Watch out for the next episode and tune in.
Thank you for listening to the Emerging Markets Equities podcast brought to you by Aberdeen. Please subscribe wherever you get your podcasts, and for more great content, visit aberdeen.com.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for informational purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The companies discussed in this podcast have been selected for illustrative purposes only, or to demonstrate our investment management style and not as an investment recommendation or indication of their future performance. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.